This is our Forex blog for March 7th, 2014, and these are our currency indexes, which in my opinion is one of the easiest ways of trading. Just like the NASDAQ, Dow Jones, S&P 500, we actually created synthetic charts ourselves that only exist in our software that shows you visually as a chart what each currency is doing. And basically, in a nutshell, as you probably already guessed, you want to sell the weakest currencies versus the strongest, and if the strongest is on the top like the euro, you want to buy that strong currency versus the weak, such as you want to be buying the euro dollar until the dollar got super strong here at 8:30. The yen, pretty much the entire day, you want to be buying the euro yen. Now, for those of you who don't want to have to learn the 50 to 100 things that you need to know to be a professional full-time trader and make a living trading, support resistance, money management, position sizing, Fibonacci retracements, fib targets, fib time extensions, trend lines, Andrew's pitchfork, trend channels, the list goes on, not to mention our own statistical tools, which are about 24 of. You can just simply run our signals. Now, in some instances, markets are just dead, and I haven't really put too many breakout signals into my signals because I auto trade these myself, and I am seeking the ones that tend to be more accurate, such as double bottoms, double tops. In this case, this double bottom signal here failed. The trend's down. But you can see, the wins are bigger than the losses. You have a small 5 to 8 pip win, 10 pip win, 15 pip win, 8 pip win, 25 pip win, 18 to 20 pip win, and so forth. And one win can get rid of even 2 to 3 and sometimes even 4 losses. And we move the stop as the trade starts going our way. So we have a lot of break-even trades as well instead of losses. But in a nutshell, using the currency indexes, just trade the strong ones like the euro versus the weak ones like the dollar until 8:30 here. And there's two main entries that we use: sideways breakout rectangle patterns and pullbacks. And today's more of a rectangle breakout day. There really wasn't any pullback. My preferred method is pullbacks, and that's why there really wasn't any. We measure everything statistically. How far does the market go during different times of the day? And if it makes a higher high than the previous swing, we're looking to buy pullback. But for safety reasons, because buying the highs typically is a risky bet. If you do that every day in every currency, you'll lose money. So I need a deeper pullback. But on most days, you'll see, markets going up, and then they pull back, and then that's where we buy, and then they go up again. Sometimes they double top right here. If the momentum, the second wave up is not as much as the first, we sell it. If it's stronger now than before, then we don't. We'll hang on to the buy that we already have. Some days, like in the euro today, there's really no high probability trend trades to teach a system, but a human could easily, knowing that the euro is strong and the dollar's weak, buy this here, buy this little wedge pattern right here. And most of the time, when it goes up like this and barely up a little bit more, if you draw your fibs off of there, the 1.618 fib target usually is going to be the maximum move. So you have an idea of where your profit target is ahead of time. And you can see in this case it went up to the 2.0 level. You might need to zoom out and find a little bit lower swing, maybe this one right here, to get a more accurate fib level. And you can see the 1.618. I mainly just show 5-minute charts for class, but any time frame works. Remember, the euro was strong, the dollar was weak, the yen was also weak, and you really only have one pullback trade here that I would consider to be decent. You put your stop underneath here and just astronomical win. The rest of the time they're kind of rectangle breakouts. And typically the longer it goes into a small rectangle where the high and the low of the rectangle is 15 to 25 pips, the better. The tighter and the longer it lasts, the more accurate it is. But you can see rectangle breakouts are pretty high probability. It's very hard to teach a computer to trade those because you don't know how far back to go. I probably eventually will create a subroutine that goes back over the last 2 hours and sees what the highest high and lowest low is, and then if it breaks out, get into it if the euro's trending up and the dollar's down, and so forth. But let's take a look at some other examples today. What's nice about the indexes is it clearly lets you see reversal patterns. Here you have a double bottom. It went back up again. Typically, if it comes back down again and breaks here, it's going to have a big move down, but it didn't. This is a very high probability place to go long. You put your stop underneath here, and that's at 7 o'clock. What's weak at 7 o'clock? Well, the dollar is weak, but it's also underneath the lower band. The yen is weak, but it's not down too much. Usually underneath or above these upper bands, the market stalls and either goes sideways or pulls back. So the yen would have been a really good one to be trading against the pound. So at 7 o'clock, you're looking to buy the pound yen. It's that simple. And there's probably a pullback or a rectangle pattern on there. Here's 7 o'clock. And you can see this one, even though it looked like a very good trade on the chart, it really didn't take off right away. You can see it popped up. Your stop was underneath here. And you might have even got out of this trade, and once it came back down, it never really went underneath that 50 level. The 50 and whole numbers tend to be support resistance. That's another good place to get in. And the second trade's the one that gave you a huge, almost 90 pip profit. But you knew about it ahead of time because the pound was very likely to reverse. And a lot of times when you see reversals at the bottom, if the weekly and the monthly trend is up, they're even more high probability. Just trying to find some patterns on here. Here's the previous day's high. You can see it went up. This is a decent pullback in this currency. Anytime you see strength, breaks the resistance area. Sorry, I didn't mean to get that one. You have a nice little pullback right here coming up to 630. We know that the yen was also weak. So what we'll do is look for buys on the Swiss yen at 630 to 7. And you can see in this case, the 630 breakout went up from 32 to 52, went up 20 pips. And then you got a nice little pullback right here. And you might have got long about a bar or two before it really exploded up. But the key to trading, and you're not always going to have big wins like this, but the key to trading is having small losses or small risk and bigger profits. And so the winning percentage doesn't even matter when that's the case. You can be wrong 60, 70% of the time. If you're getting 3 times bigger wins than losses occasionally, you'll make up for that, because a lot of trades, once they start to go your way, you kind of move your stop up a little bit. Let's say this was your original stop, starts to go your way, you cut your stop in half. And so a lot of times when they come back down and stop you out, you lose half of what your original risk is. And the trades that work give you many multiples. So when you combine, maybe 30 to 50% of your trades is half or less losses, the other half are the full initial risk amount, you end up with, when our average initial risk is 7 to 10 pips, you end up with 5 to 6 pip average losses, and your wins, tend to be 15 to 25 pips. Some days less than that. Obviously, some days you have to grind out a bunch of 5 to 10 pip wins. But there's days where, like yesterday, the euro just keeps going up and up. So you just, hang on those big 30 to 50 pip wins.